Okay, so good morning all. Well, I just have to say what a fantastic session earlier. It's been very insightful, but it's absolutely fantastic to be here with you all today, and I really thank you for the opportunity. Now, for those of you who may not know, Optimum have recently merged with Pepper Money, and therefore they've also become active in the second charge market, which is another product adding to their fantastic proposition, if I may say so myself, to help more of specialist customers achieve their home ambitions. Now, today, what I plan to do is simply give you a whistle-stop on a product that I don't think we talk often about, and probably not enough about, but a product which I think now more than ever before should be in every advisor's toolkit, and that is a second charge. Now, I'm actually really passionate about the product, only on the basis that I have seen so many customers who have wanted to achieve certain things, even from a consolidation of debt right through to achieving home ambitions, which, as we all know, has been probably precedent in most people's lives. I know I've had to revamp my house in some shape or form, having to work from home more. So I'm hoping by the end of this session, you will give a second thought. So over the next 15 minutes, I'm just going to do a quick brief overview of the seconds market and talk about the impact of COVID-19, although I think we kind of know about that. Some of the myths surrounding second charges, how a second charge could be key armoury for an advisor in 2022, and also to look at the typical customer, which actually I think most people will be really surprised about, which is probably my favourite slide, followed by how to access such products. So looking at this market in isolation to the rest of the mortgage market, seconds is certainly a growing one, with last year being a sizable one of 1.1 billion in size. And in fact, in Q4 last year, we saw the highest record lend since 2008, and trajectory for 2022 insinuates this will be another year of momentum and success. The market has certainly been adaptable and resilient, which is obviously reflective of the brokers and the lenders that operate within it. Now, whilst this now has been the case, historically, as most of you know, there have been a number of myths surrounding this product, particularly pre-credit crunch, I'd say. Number one being it's a small flat market. There are large fees associated with it. We actually require a borrower to pay a greater proportion of interest in the earlier part of their loan cycle, which then decreases the savings for the borrower as part of Rule 78. Poor regulation, followed by seconds being really expensive. And also, finally, and as we can probably all relate to in some shape or form, a slow, painful journey. So too many document requests and the lack of transparency of the process. But actually, the reality is very, very different. Since obviously the introduction of MCD, second charges are now more aligned with first charge mortgages, and as such, all the same MCOB rules apply. And actually, if you've actually been a person who processes second charge mortgages, you'll see it's very, very similar to a first charge. Mortgage illustrations are probably one that are identical to first mortgages, so hence transparent, as are ERCs. So it's really another tool that is worth considering because it can just give you more choice when you're talking to your consumers. But also, if a customer needs money quickly, 24-hour offers, completions in under 2 weeks. Fees are also significantly reduced. Gone are the days of brokers deemed to be supposedly charging like 30% in fees on an application. I mean, in some situations, there aren't any fees at all. So it is worth really looking at it. Times have changed. And over last year, 27,000 customers were helped. And Optimum / Pepper Money actually helped more than 8,500 customers last year. So that's a considerable amount of people who were able to help. In terms of products, we've got 2-year, 3-year, 5-year, fixed rates, trackers, variables, discounted, you name it, we've got it. And rates start from as low as a 2. So again, very much aligned to a first charge. We go up to 100% LTV. And also, we have adopted and embraced technology. So, we use, and quite a lot on a second charge, a lot of automated valuations, which obviously removes the need for, to wait for a valuer to go into a property, AIPs within minutes, and EID, and all the great stuff that you can see on a first charge. And loan amounts varying from 5,000 right through to 1 million. So really serving a variety of customer profiles, and particularly as we've seen, I think, over the pandemic, customer profiles have certainly changed. So I'm not going to hone on it too much, but obviously, because as most of you probably know, why a second charge? But all I'll just say is just keep this very simplistic. When you have a customer in front of you, just think 3 options: a remortgage, a further advance, and a second charge. I was talking to the FLA last week, and they were saying that 74% of advisors do not even consider a second charge at the first outset. So my question is why? If it's a lack of knowledge, please reach out to any of us, because it should be as part of your toolkit. I'm not saying 100% of the time, but it certainly should be a consideration. At the end of the day, I'd say probably we're creatures of habit. So I'm just going to touch upon giving you some ideas as to when remortgages or further advances are simply not a suitable solution, and actually a second charge may be. So a customer wanting to raise capital more quickly than the first charge can allow, so speed. We touched upon, well, Adrian touched upon earlier around how 5-year money is really cheap right now. So a customer may not want to lose their existing interest rate by remortgaging. They may be on an interest only, and by switching over they will, their application, they'd need to go to a repayment, which may be more costly for them. But also, they cannot obtain a further advance from their existing lender. They may need money for all sorts of circumstances. I think the most wacky one I saw was somebody wanting to borrow for a boat. But all sorts of things will lend on: tax bills, school fees, businesses. They may want to avoid paying early repayment charges. They also may be failing affordability with a high street lender, so, or their existing lender has tightened up their criteria. But also in terms of, we talked about affordability earlier as well, potentially being a little bit tighter. We have a little bit more flexibility. So if a customer is at their first charge lender and they've reached their salary multiple limit, we will look and be more flexible. So for example, the typical one being 6 times. So potentially also better value when the customer is on a good first charge deal, as I touched upon, but they might want to borrow more than a personal loan will allow, and they just want the speed of that. But also they may want a different term to their current mortgage. And in some situations, a rate that is cheaper than a credit card, unsecured loan, or even a bridge. So I'm just going to quickly go through a couple of scenarios of where a second charge would be suitable, just to kind of bring it alive a little bit more. So customer with a lifetime tracker, the existing lender cannot offer additional borrowing. So this customer actually wanted to borrow an additional 150,000. So in total, their their lending requirement was 300,000. Now, so the option 1 is to do a remortgage of 300,000, and on a high street rate, it's 3.1%. Or the second option is to do a second charge of 150,000 at a rate of 3.4%. And actually, if you're leaving the first charge in place over a blended rate, that's 2.65%. Plus, a second charge could be over a shorter term to reduce the total amount repayable. So just one option. And this one is the next example, and I guess this is probably the one that I think most people probably don't consider maybe. And this one's around a customer being on a good first charge deal. So this scenario is very much the mortgage that the customer had was 390,000. All they needed was to borrow 50,000 to purchase a car and undertake some home improvements. Again, the option 1 being to remortgage to give an equivalent, and this would give them an interest rate of 3.1%. Monthly repayment, 2,109. Option 2 is obviously to keep the existing mortgage and have a second charge just to top up the 50,000. And the rate is higher, yes, at 4.6. And this would increase monthly payments by £281. So the assumption is actually, monthly cost on remortgage is certainly much cheaper when you multiply it over the 36 months of the remaining term. So cheaper by £1,500, or just shy of. However, when you take into account the early repayment charge, this actually attracted an additional upfront exit charge of £11,700 to the customer compared to the arrangement fee for this one, which was £1,000. So when all costs are considered, the second charge actually works out to be much cheaper. So in situations such as this, it would probably be better for a customer in this scenario. So I think the summary is give seconds a second thought. I'm just going to quickly give you a whistle-stop of several reasons to have a second charge. So obviously we come across all sorts of scenarios where it might be applicable, matrimonial settlements, home improvements and debt consolidation tend to be the bigger ones. School fees tend to be quite popular as well. Car purchases, holidays, legal, tax bills, you name it. Buy-to-let purchase, business, family gifts, you know, it's there as long as it's legal. And again, as I touched upon earlier, up to 100% loan to value, fixed tracker rates are available, lending right across England, Wales, mainland Scotland. And we do look at complex income and support those with adverse credit. Self-employed, 1 year accounts. All I'd say is very, very similar, again, to a specialist lender. And look at also quirky properties and ex-local authority. Now, this is my favourite slide, although, and the reason why I do this is only because I still think there is a myth or a misconception about the typical customer profile for a second charge. But actually, the majority of our customers, based on our statistics, show that the average income is for a customer is 72,500. They have a property, a 4-bed property at 428,000. 65% loan to value is what they're that the borrowing goes up to. Average loan is about 40,000-ish. 8-year term, fixed seems to be a very popular one, and 5-year fixed seems to be the most. But actually, it's a prime customer with a low credit score. Now, actually, we do want to serve all of them. You know, we want to serve all customers. But I just thought it was quite interesting because I think this solution has always been thought about for somebody who is in need. So how do you access second charge products? So there's two ways. If you go to a master broker or specialist distributor, that is one option, or go direct to a lender. All I'd say is definitely consider it, because I do think with cost of living, Bank of England interest rate rises, etc., it's worth consideration. Check out all the lenders' websites, talk to as many second charge lenders as possible, and learn about what their offering is, because it could actually help customers. And actually what I have found is when I went, a few years ago, I went to see a financial advisor who sat in front of me, who was not interested in talking about it. And actually, he'd actually turned away 3 customers previously when actually he could have helped with a second charge. So after that visit, I actually felt as if I'd done good, because actually he was able to go back and help. But it was just remembering it. 3 things: remortgage, further advance, second charge. And just also to say that obviously everything is online, same as a first charge mortgage, so please consider it. So in summary, lots of opportunities. I think this is a buoyant market and actually an exciting year. Yes, we've got all these challenges, but I think it's all about working together as a broker community, because we really do add value to our customers and they really do appreciate it. So let's just write as much business as we can. And seconds should formulate a part of your daily advice and be in your toolkit. Thank you very much.